Welcome back, Patriots. Dan here with VictoryX Financial. Hey, today we're answering a big question. Why do we use indexed universal life instead of whole life for our RETIREMAX ELITE strategies? Well, if your goal is maximum tax-free retirement income, this may be one of the most important distinctions that you'll understand. So let's check it out. So when most people hear the words permanent life insurance, they immediately picture whole life insurance, and for good reason. Whole life has been around since the 1700s. It was originally created by organizations like the Presbyterian Ministers Fund back in 1759 as a way to provide a death benefit for widows and families. So in the mid-1800s, companies like New York Life and Penn Mutual brought it to the US and built the foundation for the modern whole life policy. Now, over time, business leaders like Walt Disney and Ray Kroc, J.C. Penney, even the Rockefellers used whole life cash value to fund businesses during tough times. So yes, whole life has a long history, and yes, it still has its uses. But here's the truth. Whole life was designed primarily for guarantees and death benefit, not for building maximum retirement income. And that's where IUL comes in. Now, in 1980, investment firm E.F. Hutton created Universal Life. And it was designed to be more flexible than whole life and to focus on living benefits, meaning cash value that you could actually use. And then in 1997, indexing was added. So now your cash value could earn credits that were tied to market performance while still protecting your principal against market losses. And here's the kicker. Under IRS Code 7702, those gains can be accessed tax-free. Now, since the 1980s, we've had rules like TEFRA and DEFRA and TAMRA, and these laws were driven by lobbying from big banks and Wall Street firms because, well, life insurance was simply too attractive compared to 401ks and IRAs. So the IRS basically said, if you want tax advantages, you have to carry a certain minimum death benefit, which is why policy design matters so much. See, with IUL, we can shrink down the death benefit down to the legal minimum. So more of your premium goes straight into cash value growth as opposed to just paying for a death benefit. Now, whole life comes with guarantees. You have guaranteed interest, guaranteed dividends, right? So sounds great, but every guarantee comes with a cost. You have higher internal charges and more premium needed to support those guarantees, therefore slower cash value growth. So while you're paying for safety, you're also limiting your growth. Now with IUL, we can design a policy with a lower death benefit and insurance that actually gets cheaper as you get older. Why? Because IUL is market facing. See, carriers use stock options to help credit your account each year. So your money can ride the growth of the market without taking on the losses of the market. And the strategies can be managed year to year, unlike whole life, which locks you in on day one. So our clients often see 8 to 12% average annual credits with IUL policies, and in many cases, even more. And meanwhile, as the cash value grows, so does the death benefit. So let's compare two examples. Same client, 35 years old, excellent health. He wants to transfer $5,000 up front and then contribute $900 a month until age 66. Now with the whole life illustration, we need to start with over $500,000 of death benefit. And by age 67, he'd have about $650,000 of cash value and a $1.2 million total death benefit. Not bad, but limited. Now the IUL illustration, we start with just $250,000 of death benefit, and it's broken up with a term blend to reduce the cost even more. So same contributions, $5,000 up front plus $900 a month, and by age 67, his cash value is almost $1.2 million, and his death benefit is nearly $1.4 million. And here's the best part, his tax-free retirement income, over $108,000 per year for the rest of his life, even if he lives to age 120. And if he lives to age 87, his family still receives about $835,000. That's nearly $3 million in total benefit from just $339,000 contributed over his lifetime. There is no whole life policy on earth that can do that. Now, before I completely throw whole life under the bus, here's where it does have a role. So we're launching a brand new program called Debt-Free Vet. And this program is designed to help veterans and their families pay off debt, including their mortgage, in half the time without spending a single dollar more than they're spending today. And this is one of the few strategies where we still leverage whole life contracts because the guarantees are powerful for debt elimination and cash flow control. So I'll be covering Debt-Free Vet in detail in an upcoming video, so make sure you subscribe and stay tuned. All right, so let's recap. Whole life has a history, and it still has specific applications, but for maximizing retirement income, IUL is the clear winner. Less wasted death benefit, greater efficiency, more flexibility, and the ability to create massive streams of tax-free income for veterans, for first responders, and patriotic families. So if this all makes sense to you, hit that like button and subscribe to the channel, and drop a comment below or message us on Facebook if you'd like to see your own numbers. And don't forget, visit victoryxfinancial.com to download your free Veterans Wealth Guide. Until next time, stay sharp, stay ready, and I'll see you in the next video.